My name is Gareth Soloway, and I was a losing trader until I mastered technical analysis. Logic and charts beat hype and narratives every time. Now I teach investors the same techniques that made me a multi-millionaire. This is my trading game plan. Good morning, everybody. Welcome to this Monday morning edition of My Trading Game Plan. Of course, I'm Gareth Soloway here to guide you through the chart analysis, strictly data and charts, no BS here at verifiedinvesting.com. All right, so number one, markets are falling sharply this morning. All right, couple things. Last week, I warned you about this. I said, guys, everyone's on vacation, at least the big traders, the big institutional money. They take the whole week off of Thanksgiving. They come back and they go right back to what was happening prior to that week, which was selling pressure, essentially relying on the retail investor to buy the dip and push the markets up. In addition, we talked about how the Japanese 10-year yield had stalled out of its run to the upside that was freaking markets out. If that resumed, and it likely would, then that would cause more selling. That's exactly what happened here in the markets in the overnight. So the Japanese central bank looking more hawkish. We're seeing again the 10-year yield in Japan spiking to new multi-decade highs, last seen in 2008. And ultimately, folks, we're in for a wild ride in the markets. Let's look at the charts. Let's take a look at what we have here. So what we're looking at here is the S&P futures. This was Friday's action. Remember, it was a short week. So again, a shortened day as well. So this was closing at 1 p.m. Eastern time. Once the futures opened last night on Sunday at 6 p.m., they just started to sell off. Look at this sell-off all the way till 1 a.m. Eastern time. And then since then, we've chopped around into the open this morning. Markets will be opening shortly. All right, we're setting up for a pretty sharp drop, about a 42-point drop on the S&P 500. Now, again, this is where technical analysis rules the roost and gave us a heads up of this likely sell-off. Let's go back to the charts. Let's go to the S&P 500 chart. Let's flip over to our chart here on our weekly. One of the things we knew about the chart on the weekly was that we were still underneath this bigger parallel. And remember, we've talked about how this could be a cycle high. And even though we were getting a great bounce, we had to be careful because, again, it was likely, number one, during the holiday Thanksgiving light volume week. Number two, we were still underneath this resistance. Flipping from the weekly to the daily chart, I mentioned how there was a gap fill here and right around the 786 Fibonacci. Literally Friday afternoon, if we go to the S&P, the last candle of the day into the close tagged that trend line. That's amazing, folks. I always say gaps are meant to be filled, meaning it just draws price to fill it. But literally the final 10-minute candle of the day on Friday, 12:50 to 1 p.m. Eastern time, we tagged that gap fill. We go back to the daily chart. There it is right there. And look at what the markets are doing today. We're seeing the selling resume to the downside. Remarkable. Now, flipping over to the QQQ chart, we had this beautiful parallel that was keeping price in check all along the highs, even over here in late October. We had the support line here. It broke. It confirmed. We came right up underneath this. If this doesn't break, markets are just getting a bounce. That's what technical analysis teaches us. So while a lot of investors were getting euphoric again, as the market had 5 up days in a row, about a 5% move up from the lows, it wasn't, again, based on technicals and charts and data. It was just a bounce for now. Now, it doesn't mean later on it can't resume its upward momentum and break through these key levels. But the key is, in technical analysis, you respect the level until proven otherwise. Always remember that, folks. A lot of us, it's just human nature to assume. We make assumptions, and that gets us into trouble when it comes to trading. Okay, let's flip over to the Japanese 10-year. All right, so again, when we saw the markets bottom out about a week and a half ago, that's when we made our high here on the Japanese 10-year yield before pulling back and chopping last week. So again, you can see the 10-year just kind of went like this until overnight when the Japanese central bank again came out more hawkish. Now remember, Japan has debt to GDP that is a whopping 240% debt to GDP, right? So this is telling you that they may have even lost control. So, in my opinion, I think yields are going up, and the Japanese central bank has no choice but to probably raise rates to keep pace with this. Because ultimately, remember, the 10-year, the 20-year, the 30-year, the markets control those. The Federal Reserve banks don't, right? They control the short end of the curve. So, yeah, sure, they could lower rates if they want to, but if the 10-year, the 20-year, the 30-year continue to go up, what does it even matter? You're still paying more for debt. It's just the short term, which is the bank lending rates. That's what's kept lower. And again, just an interesting little, issue here. So the 10-year yield in the overnight in Japan spikes to new highs not seen since 2008, the financial crisis. And again, it sends ripples through the futures market and the stock market and the bond market. The dollar is breaking lower. So we talked about this trend line near term. Again, we've saw multiple hits right on this 10-year. And this is, by the way, we're going to the Dixie here, the DXY. So again, if we look at this, we can bring up let me just bring up my brush here. There we go. So we have support, support, and support. And we hit here, and now we've broken. Now, listen, in the scheme of things, this is just a minor breakdown in the dollar. We're still trading below this level on the DXY of about 100.3 to 101.3 and support down here at 96.5. But in the near term, this certainly is a near-term break that could see us continue and maybe even retest that major support on the dollar. So again, the dollar is under pressure today. Now, that's helping gold and silver. And don't worry, we'll be talking about gold, silver, and Bitcoin in just a little bit. Wow, what crazy moves in those markets. And we'll go to that in just a second. All right, the 10-year yield. The 10-year yield broke lower. Look, it tagged this lower trend line right here. This trend line going back to April right there. And then sure enough, it's bouncing and even trying to fight back above this level. And the whole idea here is you guys might be thinking to yourself, well, why is the US 10-year going higher if there's a rate cut coming in basically less than 2 weeks now, right? We're basically looking at the 12th of the month as the Fed decision, and essentially it's priced in, expected to be a rate cut by the Fed. And the answer is this: when all other yields, like when Japan is seeing their 10-year go up, it's going to bring up all rates, guys. It just is. Because why? Well, because people are getting nervous. If the debt of Japan is an issue and investors or buyers of their debt are demanding a higher interest rate, what does that mean about people looking at the U.S.? Could there be that they feel the same way, or at least partially the same, about U.S. debt? And the answer is yes, right? I mean, again, if you're concerned about this country with 240% debt to GDP, the US has 130%, it likely is going to bleed over to some extent. And so we're seeing the yields in the US move up, even in spite of a likely Fed rate cut in December coming up here in just a couple of weeks. All right, flipping over to NVIDIA, guys. Here's your little upsloping parallel on NVIDIA. We did see a breakdown on this. I've been doing a lot of kind of analysis on this chart of NVIDIA, and it certainly does look like it's broken down. And the idea here is we are down today on the back of this, and we're likely headed here. Now, Jim Chanos, one of the famed investors out there, he brought up something that was amazingly important to recognize. So I've alerted you guys to the depreciation schedules that these hyperscalers are using in the AI space. They're using 7-year depreciation, when in reality, an AI chip today loses 90% of its value in 2 years. All right, so that's an issue. We've seen these AI companies shuffling money back and forth. Remember AMD basically getting $100 billion from OpenAI, or OpenAI spending $100 billion on their chips, but then AMD giving warrants to buy shares at a penny per share of AMD to OpenAI, something like $140 billion worth, whatever it was. The point is, we've seen this from NVIDIA, AMD, Oracle, all of these players shuffling money back and forth in a very kind of suspect way. All right. Again, like, are they creating more demand than there actually is? Now, Jim Chanos today brought up an amazingly good point. He brought up the fact that these new cloud companies are using AI NVIDIA chips as collateral for loans. So imagine you buy a couple chips. And by the way, All right, so let's say we buy 100 chips from NVIDIA. And then we go out and say, hey, we need $1 billion loan. And we say, we'll put those chips up as collateral. Okay. But wait, those same chips depreciate by 90% in 2 years, are essentially worthless. Could there be an issue here? Could this ever go wrong? And I'm being a little facetious in saying that. It's like, dude, this reminds me of the financial crisis in terms of real estate. Remember when people were able to get loans at pennies on the debt, et cetera? I mean, it was just like they were handing out free money, and then it's like, oh, surprise, surprise, it actually went bad and caused a collapse. Well, this is now happening in the AI space. Something to be aware of, folks. All right, going back to the charts here. So we have NVIDIA downside target around $150. Again, we're trading at 175, a far cry from the 212 it was just at. SMH, don't forget, this is the chart heard around the world. This again, 102% extension from its weekly 200 moving average, and then price fell 45%. Here we have it again, 102% extension above the 200 weekly moving average, and then price fell 40%. What is going to happen here? We had the top at 102% away from the 200 moving average. To me, I look at this and I say, okay, yeah, you'll get some bounces, but chances are we're coming back. And you can start to see the writing on the wall, guys. Again, doesn't take a genius. I certainly am no genius to understand that when you start to see things going on in these sectors, there are problems, and we have to keep that in mind. All right, let's continue on our merry way here, folks. One chart that's hanging in there today is the chart of Amazon. It's basically flattish, down slightly. There were good sales over the Black Friday holiday. So listen, the consumer is spending, at least the high-end consumer, because the stock market remains near all-time highs. And we've seen this year is that investors or consumers are still willing to spend heavy amounts around the holidays. And again, we saw that in the data here. So Amazon is reaping some of those rewards, at least today. I don't know if it lasts, frankly. I don't think it lasts. But again, just wanted to point that out. By the way, 25% of new loans are being rejected now. These are levels not seen in recent history, guys. Is that when people are going to either get mortgages or loans or any sort of essential loan, the rejection rate is now at levels not seen in a really long time. So there is some major cracks going on here, folks. It's just a matter of how long it takes the house of cards to fold. Will AI kind of cushion us a little bit, or will it ultimately contribute? I think longer term AI is going to cushion potentially, but in the near term, the valuations have gotten way out of whack. JP Morgan Chase. This is a big one, guys. JPM is one of the key stocks that I'm monitoring for when the market finally really loses its last drivers. These financial stocks, they've been holding up. You can see here, it's still stuck within this parallel. All right. Once this breaks down here, notice how I'm saying once, not if. Once this breaks down here, that's going to be another nail in the coffin of the market. All right. Couple other things. We're going to flip over to Bitcoin now. Bitcoin taking a major dump with the markets in the overnight as a run for safety continues. Remember all those people talking about how Bitcoin was not correlated to the stock market? I think it's pretty correlated. I think we can all agree, folks, it's generally correlated. Now, listen, it's also a leading indicator. It topped out just like in 2017. It topped out 4 to 6 weeks prior to the stock market. In 2021, it topped out 4 to 6 weeks prior. In this cycle, it's topped out 4 to 6 weeks prior as well. And we've seen a lot further downside than in the stock market, but it's basically telling us that people are de-risking even in Bitcoin. All right. So where's Bitcoin heading? Well, listen, it's nothing, listen, it could always bounce up, right? I mean, there's always a chance that we still fight back here to this level, but you guys know I'm steadfast that eventually we see the 73 to 75,000 level on Bitcoin. All right. It had a good bounce over the last week, but what else bounced over the last week? The stock market, right? The stock market also bounced. And so that correlation of risk on retail buying Bitcoin, for instance, pushing it up while institutional money's on the sidelines, that again is now gone. Institutions are back. And here we are seeing selling. Excuse me. All right, let's go to gold and silver, guys. We're going to start with silver today because silver is really the standout. Silver surging to the upside. Incredible move here. So again, high pivot, double top, third hit blows right through it, and silver is now trading near $58 per ounce. Incredible move here. Now, if we confirm today, we've then confirmed above this high at 54. That would then become your first support on the way down. In addition, we have this beautiful upsloping trend line right here, which will add additional support. So if we confirm today with a secondary close above Friday's highs, then again, silver has confirmed, and you would assume this becomes your first line of defense between 54 and then down to about 52.50 in terms of a retrace that could knock silver and rally it even higher. Now, let's talk about this. I'm going to clear off all my lines. I want to show you my near-term next target on silver. All right, now listen, I thought silver would pull back more. It didn't. It shows the resilience and really it shows the lack of trust in the financial system, frankly. But what we do here is we can take a trend line and connect it perfectly through these lows. So see how it connects perfectly through low number one here and all the way back. Now bring that up to this high. And that is my level. I'll be looking for this either today or tomorrow to short into as a day trade. And I do actually have a little short on the swing trade side that I mentioned last week. I'm still holding that, and I will add up here and then look to bring my average up and then look for that pullback. And then I'll probably end up getting out right around 54 as that's technical support. And yes, you could make a case for a cup and handle pattern here. It's not the best pattern. Usually you like a little bit more of a bull flag here, but nonetheless, you certainly see this type of thing. And I got to think that silver likely heads close to that $60 per ounce level on the charts. Now let's flip over to gold. Now gold is not hitting a new all-time high, but potentially it's going to confirm above this wedge pattern here. And so if that does happen, then it does open the door for us to potentially retest those all-time highs. My only one thing on this chart is we do want to monitor this prior pivot right through here. So again, you have this one little high. Now, this would only be a minor level of resistance, but it still has to be just monitored per the chart just to see how it reacts. But my guess, again, is if we confirm here the breakout above this wedge pattern, we're likely headed back to our all-time highs. Now, whether or not we get through that, that would be a double top. Now, remember, silver hit the double top weeks ago, and it pulled back. So we don't know if gold yet will break through. Like I said early on in this broadcast, we must make sure that the chart proves itself. We can't assume it's going to break. So right now, double top would be that resistance line. You would expect a pullback unless it confirms above that. If it confirms above that, you're looking at $5,000 pretty soon on. And by the way, either way, we're going probably north of 5,000. It's just a matter of, does it happen in December or does it happen in the first quarter of 2026? All right, couple more charts to go over here. Let's take a look at U.S. oil, crude oil. We did talk about crude oil as a potential cup and handle. I did go long last week on that based on this right here. So you can see, again, look at in the overnight how we tagged that line again. We tagged it here and got rejected every time. Now, part of the issue here is we're seeing a little bit of traction in oil because of the potential war with Venezuela, as President Trump has been basically making more and more threats about military action over there. And also just the fact that this is a bullish chart, right? So again, we never know the narrative that the media is going to spin, right? It could be like, you know, oh, there's a lack of supply. Oh, there's more demand. Oh, there's a potential war, right? These are all things that ideally a good technician should be able to see in the charts ahead of time. And that's where it comes in here, where at least as of now, this cup and handle has been building, right? And we still have this. Now, the question is, can we break out on the chart of crude oil? Now, lastly, natural gas, guys, going to nat gas. Nat gas had a good rally on Friday, basically flattish today. All I care about on this, again, guys, is can natural gas rally up into this level, the $5.30 level, coming right back here. That should be major resistance, major resistance, okay? So, listen, earnings season, yeah, there's a few earnings here and there, but really the big players have reported until we get into mid to late January. But now we're dealing with Fed rate cuts by the Federal Reserve coming up in less than 2 weeks. We're dealing with the Japanese 10-year yield spiking, sending ripples through the bond market. We're dealing with AI issues. AI companies or cloud companies using chips as collateral, even though these things depreciate so fast, which again means that the banks lending this money could be on the hook for substantial amounts, and valuation concerns in the other AI stocks. So there's a lot going on here. Earnings right now are not the major driver, but a lot of factors we need to stay on our toes with. I will, of course, keep you posted, as will everyone here at Verified Investing. Don't forget to tune into Trading the Close later today at 4:20 with Drew Dosick. He's one of my best traders out there. Incredible insights in that 4:20 Trading the Close. And as always, folks, we're right here at Verified Investing to help you through this wild market using probability and technical analysis, one and the same. Have a great one, guys. Thanks so much for tuning in. Talk to you soon. Take care.